72 hours ago, President Trump made a decision that 3 separate defense analysts are now calling the point of no return. The decision: authorization of expanded military operations in the Persian Gulf region, including repositioning of 2 additional carrier strike groups and activation of reserve units specializing in Middle East operations. And here's the assessment that should concern every investor watching this. The Institute for the Study of War published their updated conflict probability index yesterday. Iran-U.S. military confrontation within 90 days. 90%. 90%. That's not speculation from internet commentators. That's a peer-reviewed defense think tank with a 40-year track record of geopolitical analysis. But here's what nobody in mainstream media is connecting. And I'll reveal this later in the video. The commodities market is already pricing this in. Oil, gold, silver, shipping rates, defense stocks. The smart money moved 72 hours before the public announcement. When you see what the markets knew before you did, you'll understand why this isn't just a geopolitical story, it's a financial survival story. I'm John A.G., stay with me, but the military positioning is only half the story. What's happening diplomatically tells you everything about the timeline. 3 European allies have withdrawn ambassador staff from Tehran. Insurance companies have suspended coverage for vessels transiting the Strait of Hormuz, and the Pentagon just activated dormant supply contracts that haven't been used since 2003. When you see the full picture of military, diplomatic, and economic indicators converging, you'll understand why defense experts are using language we haven't heard since the lead up to Iraq. Let me explain why the Strait of Hormuz matters so much, because understanding this choke point is critical to seeing the economic implications. The Strait of Hormuz is a narrow waterway between Iran and Oman. It's only 21 miles wide at its narrowest point, and 20% of the world's oil passes through it daily. 20%. That's approximately 21 million barrels per day. If the strait closes due to military conflict, even temporarily, global oil supply contracts by 1/5 overnight. There's no alternative route for tankers leaving Saudi Arabia, Kuwait, Qatar, UAE, or Iraq. Iran has repeatedly stated that any military attack on their territory would result in closure of the strait. They've invested decades in anti-ship missiles, naval mines, and fast attack craft specifically designed to make the strait impassable. This isn't theoretical capability. In 1988, during the tanker war, Iran successfully disrupted Gulf shipping for months. Their capabilities have only grown since, and here's why this matters for your portfolio. In 1990, when Iraq invaded Kuwait, oil prices doubled in 3 months. In 1973, during the Arab oil embargo, prices quadrupled. A Strait of Hormuz closure would be more severe than either scenario. Defense analysts project oil prices of $150 to $200 per barrel within weeks of any conflict. That's not fear-mongering. That's the assessment of energy security experts at the International Energy Agency. Welcome to Macro Shield Method. I'm John A.G. If you're new here, hit subscribe and drop a like. This is the geopolitical analysis that protects your wealth. Help me spread it. Now let me show you what the experts are actually saying. The 90% conflict probability comes from the Institute for the Study of War's quarterly assessment. Let me break down their methodology because understanding it is essential. They analyze 4 categories of indicators. Category 1, military positioning. Current assessment, critical. 2 additional carrier strike groups have been ordered to the Persian Gulf region. The USS Eisenhower and USS Roosevelt are en route. B-52 bombers have been repositioned to Diego Garcia, and 12,000 additional troops have been deployed to Qatar and Kuwait. This represents the largest Middle East force buildup since 2003. The Institute notes that such repositioning historically precedes military action within 60-90 days in 87% of documented cases. Category 2, diplomatic deterioration. Current assessment, severe. The Vienna nuclear negotiations collapsed last month. France, Germany, and the UK have withdrawn non-essential embassy staff from Tehran. The UN Security Council emergency session ended without resolution after Russian and Chinese vetoes. Perhaps most telling, back-channel communications between Washington and Tehran, which have been maintained even during previous tensions, have gone silent for 21 days. That's the longest communication blackout since 1980. Category 3, economic warfare escalation. Current assessment, extreme. New sanctions target Iran's remaining oil exports, including secondary sanctions on any nation purchasing Iranian crude. China has publicly stated these sanctions are unacceptable interference. Iran's currency has collapsed 40% in 6 weeks. Inflation has exceeded 60%. Food prices have doubled. The Institute notes that economic desperation historically increases regime willingness to take military risks. Category 4, trigger events. Current assessment, imminent. 3 incidents in the past 30 days. Iranian drone strike on UAE oil facility. Seizure of a Greek-flagged tanker in the Gulf, and missile attack on U.S. base in Iraq attributed to Iranian proxies. Each incident represents potential casus belli. The Institute assesses that the next incident has high probability of triggering military response. Combined across all four categories, their model produces a 90% conflict probability within 90 days. For comparison, their model showed 67% probability before the Iraq invasion and 45% before the Libya intervention. 90% is the highest reading in the index's history. Now let me show you what the financial markets are signaling, because this confirms the expert assessments. Oil futures tell the story most clearly. Brent crude has risen from $78 to $94 in 6 weeks. That's a 20% increase, while global demand remains stable. The entire move is geopolitical risk premium. But the futures curve is even more telling. The spread between front-month and 6-month contracts has widened to $12. That's backwardation, meaning traders are paying a massive premium for immediate delivery. Backwardation signals fear of near-term supply disruption. The last time we saw this spread was February 2022, weeks before Russia invaded Ukraine. Gold is confirming the signal. Gold has risen from $2,150 to $3,120 in the same 6-week period. That's a 9.5% move in the traditional safe haven asset. Central bank buying has accelerated, with reported purchases up 40% month over month. Silver is following, up 12% in the period. Industrial metals with military applications are surging. Defense stocks are the clearest tell. Lockheed Martin, up 23% in 6 weeks. Raytheon, up 19%. Northrop Grumman, up 21%. General Dynamics, up 17%. Defense contractors don't move 20% on speculation. They move on contract visibility. Someone knows something. And shipping insurance rates reveal the risk assessment of people with actual money on the line. War risk insurance for tankers transiting the Strait of Hormuz has increased from 0.3% of cargo value to 2.1%. That's a 7x increase. Lloyd's of London doesn't raise rates 700% on speculation. The smart money moved before the public announcement. The markets are telling you what's coming. The question is whether you're positioned for it. Now I need to explain the forces pushing toward conflict, because this isn't happening in a vacuum. There are parties who benefit from war. The defense industry stands to gain hundreds of billions in new contracts. The military-industrial complex that Eisenhower warned about in 1961 has only grown more powerful. Their lobbyists shape policy, their executives rotate through government positions, and their profits depend on conflict. Oil companies benefit from supply disruption. The major integrated producers don't need high prices forever. They need price spikes that justify increased capital expenditure and silence calls for renewable transition. Geopolitical rivals benefit from American entanglement. A U.S. Iran war would consume military resources, strain alliances, and distract from other theaters. China's position in Taiwan strengthens when American attention focuses on the Middle East, and domestic political considerations play a role. War historically consolidates political support. The rally around the flag effect is well documented. Economic concerns fade when national security dominates headlines. I'm not suggesting war is being manufactured for these purposes, but I'm highlighting that powerful interests are aligned with conflict rather than resolution. The forces pushing toward peace are weaker. Diplomatic channels have collapsed. International institutions have failed. And the Iranian regime, facing domestic unrest and economic collapse, may calculate that external conflict serves internal consolidation. The incentive structure points toward escalation, not de-escalation. Now, I need to be balanced here, because that's what we do on this channel. A 90% probability is not 100%. The Institute's model has been wrong before. The 2006 assessment of imminent U.S. Iran conflict showed 72% probability, and war didn't materialize. There are paths to de-escalation. Back-channel negotiations could resume. A face-saving compromise on nuclear inspections is theoretically possible. Chinese or Russian mediation could provide off-ramps. And the costs of war are enormous. Pentagon assessments suggest U.S. casualties in thousands in the opening weeks of any Iran conflict. The American public has limited appetite for another Middle East war after Afghanistan. These restraining factors are real. However, here's my assessment. The combination of military positioning, diplomatic collapse, economic desperation, and trigger events is more concerning than any moment since 1979. The restraining factors that prevented previous escalation have weakened while the accelerants have strengthened. Whether it's 90% or 70% or 50%, the probability is high enough that prudent investors should position defensively. Let me explain what happens to your portfolio if conflict occurs. Scenario 1, limited strikes. The U.S. conducts targeted strikes on Iranian nuclear and military facilities. Iran retaliates through proxies but doesn't close the strait. Oil spikes to $130. Gold reaches $3,500. Stock markets drop 10 or 15% on uncertainty. Defense stocks surge. Duration, weeks to months. Scenario 2, full strait closure. Iran deploys mines and anti-ship missiles, effectively closing the Strait of Hormuz. Oil immediately exceeds $150 and could reach $200. Stock markets crash 25-35%. Inflation spikes globally. Central banks face impossible choices between fighting inflation and preventing recession. Gold reaches $4,000, $5,000 as monetary system faces stress. Duration, months to years. Now, this is the scenario that triggers recession and potentially systemic financial crisis. Scenario 3, regional war. Conflict spreads to include Hezbollah in Lebanon, Houthis in Yemen, and potentially direct Israel involvement. Oil prices become secondary as military conflict dominates. Economic dislocations approach pandemic levels. Supply chains fracture. Global trade patterns permanently shift. I'm not predicting any specific scenario, but I am telling you that your portfolio, your retirement, your financial security is directly exposed to events unfolding 7,000 miles away. Most investors have zero positioning for this risk. That's a mistake. History shows what happens to markets during Middle East conflicts. 1973, oil embargo. Oil prices quadrupled. U.S. stock market dropped 45% over the following year. Inflation reached 12%. The 1970s economic malaise followed. 1990, Gulf War, oil doubled. Stock market dropped 20% in 3 months. Recovery only came after quick victory. 2003 Iraq invasion, oil rose 40% in the year before invasion. Defense stocks massively outperformed. Gold rose 25%. 2011 Arab Spring, oil spiked 30%. Regional instability persisted for years. Syrian civil war and refugee crisis followed. Every Middle East military event has produced significant market dislocations. Iran would be larger than any of these due to Strait of Hormuz exposure. The historical pattern is consistent. Conflict produces oil spikes, flight to safety, and extended uncertainty. Here's what I think is happening. We're in the late stages of a crisis escalation that most investors aren't tracking. The military positioning, diplomatic collapse, and economic warfare have created conditions where a trigger event could initiate conflict within weeks. The markets see it. Defense stocks up 20%, oil and backwardation, gold surging, insurance rates spiking. The experts see it, 90% conflict probability from peer-reviewed analysis. The government see it, embassy evacuations, supply contract activations, reserve call-ups. The question is whether you see it and whether you're positioned accordingly. Gold and silver benefit from geopolitical uncertainty. Oil exposure captures the supply disruption. Defense stocks capture military spending. Cash provides flexibility to deploy after dislocations. The worst position is fully invested in growth stocks with no hedges and no safe haven allocation. That's where most retail investors sit. This is my analysis, not financial advice. Do your own research, make your own decisions. But the data is the data. 90% conflict probability from defense experts. 2 carrier strike groups repositioning. 21-day diplomatic blackout. Embassy evacuations. Oil backwardation. Defense stocks surging. Insurance rates spiking 700%. The smart money has already moved. The question is whether you move before events overtake you. I'm not telling you war is certain. I'm telling you that the experts who study this professionally are showing the highest concern levels in 40 years. That demands attention. That demands preparation. That demands positioning. Drop a comment below. Are you positioned for Middle East conflict? Gold, oil, defense stocks, cash? What's your strategy? I want to hear your take. I'll pin the best responses. Share this video with everyone who has retirement accounts exposed to market risk. Most people aren't tracking the Iran situation. They don't understand the Strait of Hormuz implications. Help me spread this analysis. If you're not subscribed, hit that button now. I'm covering the geopolitical risks that affect your wealth every day with analysis you won't find in mainstream media. I'm John A.G. This is Macro Shield Method. Protect your wealth, understand the system.